Welcome to Oregon Cash Flow Pro. My name is James Barber, here to help you maximize your cash flow. Appreciate you joining us today. It is our whole life illustration day or policy review. I don't have any policies to review today, so we are going to take a look at Guardian, and we're going to look at, in particular, Guardian has two paid up additions riders. One that comes with a 10% load fee and one that comes with a 5% load fee. The one with the 5% load fee is intended to make more cash value available up front. So we're going to put together a couple of illustrations and we're going to take a look at it, and then we'll talk about what might make sense in what situation. So which one might be right for you if you're considering a whole life policy and Guardian is your choice. I'm in the middle of designing this thing. I'm a little late getting going this morning. It's tax time. Trying to get everything done before tax day is always a challenge. So that's been occupying my time a lot this week. All right, we're going to take a look at a whole life. We're going to look at the L95 product. So in general, with Guardian, if you're looking for the most cash value early on and a short funding period, you're going to look at the L95 product. If you're going to have a longer funding period, like even if it's at the base amount, you're going to fund it longer than around 13 or 14 years, I tend to look at the L99 product. That one tends to be a better long-term cash growth product than the L95. But since we're going to be analyzing these different PUA riders, we are going to look at the L99 product. And that is the one that gives us the ability to use that other rider. So I'm working on changing this in the software right now. All right, let me move this tab up so I can see your comments if you guys are there. Hey, Gil, thanks. Glad to have you join us. Let me put that over here so we can actually, let me put that over here so we can look at that. If we need to, I got to be able to monitor what you guys are seeing. And then here, so with a design on Guardian, we're going to do a level Q term blend. This blends annual renewable term. I keep wanting to look up at that as I'm talking to you. I got to look at the camera. We do a level Q term blend. We blend annual renewable term insurance in with whole life in order to reduce the cost. So as a brief refresher, how this works, the government says if you have this much death benefit, you're allowed to put X amount of dollars in. So let's say you have $2 million death benefit. You can put $80,000 a year into that policy. Okay. That's your MEC limit. If you go over that, it's not life insurance anymore. It's considered a modified endowment contract, and that comes with different tax treatment. You don't get you don't get all the tax benefits that we get with life insurance. Okay. It is still tax deferred growth, but if you access that cash in any way, it's a first in, first out. And including if you borrow from it, it's going to treat your gains first as if you did a withdrawal, and you're going to pay taxes. You're going to pay income taxes on that. So it's not generally something that we want to do. There can be certain situations where it may make sense to have a MEC policy. That's generally when you're not planning on touching the cash. Most of my clients, we want to put a lot of money into our policies We plan on accessing it either as our infinite bank or just it might serve as our emergency savings account. We might use it for just other investments as needed. So there's all kinds of reasons why we may need to access the cash value in it. And if we expect to access the cash value in it, we don't want a MEC policy. So the government says, as an example, 2 million death benefit, you can put in $80,000. They don't say how you get to that death benefit. Well, if we do a $2 million whole life policy, your premium, your whole premium, all the base premium is $80,000, right? In this scenario, we're basically locked in at what our MEC limit is. I mean, it could be lower, but essentially what we're getting at is a normal, regular whole life policy is all base premium. There's no blend to it. And so that 80,000 that you're going to put in doesn't turn into any cash value in the first couple of years, and it will start to grow cash value after that. So that eventually, by the time this policy gets to maturity, that 80,000 a year you've been putting in equals that $2 million death benefit. Ultimately, you're going to likely get dividends above and beyond the guarantees, which means your death benefit will end up being more than that 2 million because of how it grows throughout the life of the policy. But the cash value that's available in the early years, not good. Okay, so it's a very illiquid design, and it probably takes 15 or 20 years to break even with that type of a policy. So when we blend in the term insurance, whole life insurance is very expensive insurance, right? When we blend in term insurance, now we are going to shrink that whole life amount from 100% of base premium down to maybe 10% of base premium. But we still want 200,000 or 2 million in death benefit. Well, that 5% or the 10% of whole life is only $200,000. It's not a $2 million death benefit. And we still need another 1.8 million in order to put in 80,000 a year into this policy. So we get there by blending in cheap term insurance. So when we think of the costs inside the policy, if the cost is all whole life, our cost is this much, and the amount of money we're putting in is this much. And so there's no cash value that ends up in the early years. When we shrink that whole life down to a small amount, and we add in the term insurance, which adds the costs, so it bumps it up just a little bit, we're still putting in this much money. So we have all of this space that turns into cash value. Everything extra that we're throwing in there turns into cash value, minus the load fees. We still have to pay those load fees. And that's where this rider comes in that we're going to look at today. So there's two different riders to choose from when it comes to a paid up additions rider with Guardian. And this is a new feature since at some point last year or the year before when they made all the 7702 changes. So we've got this STP. It's a short-term paid up additions rider, which comes with a reduced load fee. And then we have our normal PUA rider. The normal PUA rider has a 10% load fee. The STP PUA rider is a 5% load fee. That's designed to create higher cash value for you. Hey, Ebing, thanks. Oh, it might be. I pulled it off of there's a site that I'm using that uses all different kinds of themes from different games. I just found one that was kind of close to my colors, so a little bit of a green background. All right, so that's the PUA riders that are available. That's how we turn your paid up additions dollars into cash value with the right design. Now, there's an actual additional rider. There's a renewable term rider that we can also add to this policy that Guardian will allow you to dump in 50 times the base premium in the first year if you're able to. We're not going to deal with that today in this particular design. So a case where that one might make sense to look at is if you just had a bunch of money sitting on the side that you wanted to dump in one lump sum right at the beginning of the policy, and then reduce what you're putting in the years after. You can absolutely get a higher percentage of cash value available in year one by doing that. And it's a very efficient design. But just know we're not dealing with that in today's illustration, but it is available. So for today, I'm going to do, I just plug myself in as the client. So as the insured, we're going to see what 2 million in death benefit gets us for a mech space. And let's go. I'm going to design some scheduled and unscheduled premiums in here. Our total premium, I don't know what I'm going to be able to do for this. So I'm just going to plug some numbers in. We'll see how this ends up. And then I'm going to make some tweaks. And then when I can generate the PDF, then I'll share it with you. So we're going to try and do this quickly. And in the meantime, if you have any thoughts or questions, put them in the comments. I will be glad to answer those as we run through this design. Okay, so my first step when I'm designing this, plug some numbers in, see what they spit out, and then I can fine tune it from there. All right, so I'm going to reduce my base on this one. Don't need that much base. So we always want to try and have that base as low as possible. So the mech limit on $2 million for me would be $112,000 per year. Okay. So in order to get 2 million, in order to be able to put 2 million in, I need 200,000 in base death benefit, which is about half of where I'm at right now with this design. So let me drop this down. Hey, Gaba. Good afternoon. I've been staying up late working on my taxes. My eyes are still not quite focusing. It's like almost afternoon, but my eyes are still not quite focusing. It was a long night. All right, let's see. It looks like this design works. This is, oh no, I need 8. If I'm going to put, we're not going to be able to get up to the mech limit. So the way Guardian works, if we're going to do the mech limit, we're going to do a 7-pay design. So we're going to get that mech limit down lower. So we're shooting for 80,000 to go in each year. I don't know why. We're just pulling that number out of the air. So we're going to do an 8,000 base. And I'm going to reduce the death benefit down to 1.5 million. It should get us close to an 80,000 mech. Now, all of this, when we design illustrations for you, it's going to be based on the numbers that you want to contribute. What's your plan? In general, what you want to know before you ask for an illustration is you want to have an idea of either what's the minimum amount that you feel comfortable putting in every month, no matter what. We can start from a minimum design that gives you the flexibility to dump in above and beyond that. Or if you know the maximum amount that you want to put in. So we can design it from either of those parameters. So in this situation, I've started with 80,000. Like that was the number we started with. No reason, just pulled it out of the air. So what I need to do now is I need slightly more death benefit. we're going to go 1.6 million in death benefit. We're going to fund at that level at 80,000 for 7 years. And then after that, it's just going to drop down to our base face amount, and then scheduled paid up additions. Okay, we don't get a mech. We can almost, I need just a hair more insurance so that we can get 80,000 in year 7. So we're going to go 1.61. I think that'll get us there. That got us there. Okay. Let's take a look at this PDF. This is a classic 1090 design. Let me share this. We'll take a look. Let's do that. There we go. All right, let's see if we can make this a little bigger. Make it easy to read. This is Whole Life 95. We've got a 45-year-old male, top health rating. We've got an $8,000 base, and we're putting in 80,000 in total. Okay, 90-10 design. This is the 10. This is the other 90%. For our whole life death benefit, 338,000. Additional term insurance, 1.2 million. Now the cost of that 1-year term, this is where it's really inexpensive. For 1.2 million, $585 for that first year. Now the way annual renewable term insurance works, or what they call 1-year term, the way that works is it goes up in cost every single year as you get older. If you're buying the exact same death benefit amount. So $1 million in annual renewable term will cost a little bit more at age 46 than it did at age 45. And then a little bit more at age 47, a little bit more at 48. And that curve is going to angle up. It's going to get steeper and steeper the older you get, because the cost of it is based on what is the likelihood you're going to die that year. Well, when you get closer to age 90, it's a lot more likely that you're going to die. So the cost is more expensive. When you're in your 40s, it's not very likely. I mean, you could accidentally die, but you're not likely, you're certainly not going to die of old age, right? The factors that might lead to death are very, very low. That's why term insurance is cheap when you're young and expensive when you're old. So we're utilizing that to our advantage with these kind of designs. We want that cheap term insurance that gives us a high mech limit so that we can stuff a bunch of money into this, and almost all of it goes to cash value. It almost all buys paid up additions. Only a little bit of it goes to buy that insurance. Okay. Let's scroll down here. We're going to get to the numbers here. And I did an internal rate of return on here as well, because we're going to want to compare that to when we blend in that other rider, the other paid up additions rider that gives us access to more cash value early on. All right, this is just a summary, so we're going to keep going. That's a 5-year summary. This is the supplemental numeric. This has our guaranteed column. It's kind of nice to see in the guaranteed column, when does this thing break even? Well, we know by year 7, we've put in, what, 560,000? So we haven't quite broke even. And then we're putting in 9,000. So we're at 560, 569, 578, 587. So we break even in year 10. That's not too bad from a guaranteed standpoint. That means the worst of the worst happens. No dividends ever get paid out. You just earn the minimum guaranteed growth amount. And they're charging you the max that they can charge you for all the insurance, all the term insurance, everything. You're going to break even here in year 10. That's pretty good. That's not a bad deal at all when it comes to covering your bases. From a worst case scenario standpoint, we like that. Over here, or sorry, that's the intermediate. Here is the current one. So this is if dividends remain where they're at right now. If dividends remain where they're at right now, we end up with a break even right in about year 5. So 8 times 5 is 400,000. We just passed 400,000 right there. That's not bad. That's a pretty good deal. Now, before the 7702 changes, we could get a break even with this same type of policy, probably in year 4, or it'd be very close. Okay. So the load fees went up a little bit on the paid up additions, which is what pushed us out to year 5 on this. Okay. There's no way to get around that unless we want to pay for the other paid up additions rider. That gets us access to a little more cash value right out of the gate. Now, as a percentage standpoint, what are we looking at? 66, 182. We paid in 80. That's an 82% cash value in year 1. That's not bad. That's actually good. That's good when it comes to the Guardian designs we can do now. Prior to those 7702 changes, we could get right up around 90% in year 1. But now we're limited to usually like 79 to 82%. A lot of it's going to depend on your health rating, how much you're actually funding this at. Now, the MEC limit on this is actually 90,000. And that just has to do with how Guardian's death benefit works. You can see it's level until we burn off that term insurance, and then it goes up. Because of that, we have to have a little more death benefit than where our MEC limit is. Guardian's current practice is they will let you put in up to that MEC limit. So even though our plan is 80,000, and I can only illustrate slightly more than 10 times that base premium, I can't illustrate you putting in 90,000 a year. But the reality is they will let you send in 90,000. And if you were to do that, it would be a little more efficient. The policy would be a little more efficient. You're going to burn that term insurance off a little quicker. So we don't want this supplemental. I want to see the report that shows our term insurance blended in here, because I want to show you what happens with this. Okay, here we go. This one is the planning concept. Okay, so this shows what our actual plan is and what's happening inside the policy. We start off. We got our $8,000 base premium. We're putting in 80,000. That means 72,000 went to buy paid up additions. Well, not quite 72 because there's some expenses in there. So the cash value of the paid up additions is actually 65,000. That's how much is actually buying paid up additions. And the death benefit that buys is 179,000. That 179,000 replaces some of that term insurance. So if we look up here, remember our term insurance started at 1.271. We throw in that paid up addition, it buys this much death benefit, and that 1.271, let me highlight this right there. That 1.271 is reduced to $1,092,000. Okay? And all of that turns into cash value. This is end of year values. So this is assuming you're going to get a little bit of growth based on that number as well. So we're going to get a little bit of growth. There's expenses that happen inside these policies as well. So something to keep in mind. So that's how it works. All right. The next year, we put in more money. We buy more paid up additions. Those replace the term insurance, and our term insurance drops down again. So in this situation, it didn't buy, we're a year older, it didn't buy the exact same amount. It bought a little bit less in total death benefit, right? But it does bring down that term insurance. So while this term insurance would be getting more expensive, we're actually buying less and less of it each year until it goes away. And once it's gone, we have no more term insurance. Now we only have our base whole life and all of our paid up additions. There's no ongoing cost of that term insurance. And now our policy can be more efficient. Now in this scenario, you can continue to keep paying in the base premium of $8,000 plus an additional $1,000. Okay, and you can do that for as long as you want. If you, at any point after year 7, if you want to just stop paying those in, you have a couple of different choices. You can do a reduced paid up policy where it turns off the premiums, or you can do a premium offset where the dividends can pay for the premium, or you can borrow cash value from the policy to pay for the premium. In general, you're usually better off doing a reduced paid up or a premium offset and having the dividends pay for it rather than taking a loan to put it back in. Because our loans, when it comes to these policies, we don't have an opportunity for arbitrage with those loans. Okay. If something changes, like if we're able to collateralize this policy outside of it, again, like we were able to a few years ago and get a 3% interest rate, we can definitely get arbitrage there. It might make more sense to do that. Hey, Corey, 28-year-old, married, 2 kids, currently have 20-year 1.25 policy with 0.25 going to 30 years. Thinking of getting a whole life. What do you mean by 1.25 policy? Let me show this here on the bottom so that it's easier to read. You have a 20-year 1.25 million. I think that's what you're trying to tell me. You have a 1.25 million with 250,000 of it going out 30 years. Yep. Okay. That is what you were saying. You're thinking of getting a whole life. Okay. So right now it's all term. You just have term at 20 years, 1.25, and then another 250,000 going to 30 years. So for the next 20 years, you have a total of 1.5 million. And going out, you'll have 0.25. Okay. Whole life could be a good option. I would suggest sign up for a meeting with me. You can use my Calendly link, which is right here down below. Sign up for a meeting with me and we can discuss the specifics. Whole life can definitely be good, but what are your long-term goals? What needs are you trying to meet? And how does that fit in with your overall financial goals? That's what we want to take a look at. Generally, what we'll look at is what's your overall finances? Are there gaps that we can identify? Will the whole life policy help you meet those needs? In general, I'm a huge fan of whole life. I definitely see a place for it in most people's portfolio, but not all the time. I've met with people before that thought, hey, let's see if this is right for me. And we figured out, it doesn't, not necessarily. Like you can always get it just because it's this nice, safe growth vehicle and you've got a death benefit that will be there at some point down the road. But for the actual needs that they're telling me that they're wanting it to meet, it wasn't the right product. So that's a conversation that I like to have with people and know that I don't view it as my job to figure out any way possible to just sell you whole life insurance. Obviously, we do IULs as well, but in general, our goal isn't to sling product. My goal, this channel, my business is there to help meet specific financial needs. And it just so happens that these products are great for it. And those are what pay me, right? I get paid when I sell those products. But that doesn't mean that I have to sell those products. I'm not in a position where I'm desperate. I have to sell everybody that I can. No, my goal, we're going to meet your need. If this product helps meet that need, Great, everybody wins. That's what we want to see. So I do recommend sign up for a meeting with me so we can go over your individual situation and talk about your goals and your current financial plan. Okay, so in this, we've got the design listed. You understand what's happening with the paid up additions, how it buys paid up additions here. It replaces the term insurance. And at some point, we no longer have term insurance blended in. We have a nice big death benefit that's just going to continue to grow forever up until we pass away. Okay. Let's take a look at the IRR of this. Here we go. So this is the internal rate of return on the net cash value. We're looking at this column right here. Okay. We know we haven't broke even in the first couple of years because we don't have as much cash value as we paid into the policy. So we see a negative internal rate of return. Here by year 5, remember that was our break even. Now we've just turned positive. Now these internal rate of returns reflect the average rate of return that you've received every year in the policy at this point. So this is not a 0.08% return just in year 5. This means that is equivalent, the cash value is equivalent of you getting a 0.08 return every year for the last 4 years. Okay. So when we get down here to year 10, we're at 2.8. Now, this is the equivalent of you having earned 2.8% every year for the last 10 years. That's how internal rate of return works. In general, right now we have dividend rates that are at 5.75%. Because we have expenses in this policy, we're not going to see this get up that high. So the highest we're going to see this get is looks about 4. It goes up again down here, but let's stop up here in a realistic time frame where you're going to be able to take advantage of this thing. 4.22% is where this tops out. Okay, the assumptions being made in this, that current dividend rate of 5.75 occurs every single year in this policy, and all of the other things stay current. The cost of the term insurance that we have blended into this doesn't see a sudden increase. The mortality expenses don't increase. So there are some assumptions that get made in here, and that the insurance company doesn't adjust how they allocate the dividend. There can be some differences in how it gets allocated among different rate classes, depending on how things progress. So a 5.75 might not mean you're going to get the exact same return year after year. But we have to make some kind of assumptions when it comes to these illustrations, just so we can get a grasp on the products and be able to compare different products. So 4.22%, that's not too bad. Now remember, I like to look at whole life policies as a savings account alternative, somewhere where we keep our emergency fund as opposed to storing it in a checking or savings account. It might be a place where you have your capital expense account. So like if you're a real estate investor, you have a capital expense account where you save up some of the rents, a portion of the rents you get every month, you set aside in case you need to replace a roof or a water heater, or you have some other type of emergency that requires funds. Well, for the most part, with our emergency funds and our capital expense account, like we hope to go a long, long time without having to actually use those things. Our emergency fund, hopefully never, right? But we don't want to necessarily sit on that in a checking or savings account earning nothing for decades. You're much better off putting it into something like this, get the 4% return over the long term, have that death benefit in case something happens to you early on. It turns into a heck of a lot more cash value. You know, if you pass away in the first 15 years, that's a pretty good return on your investment there, 10% from that death benefit. And we've stuffed this thing with a lot of cash. So like, obviously a really good return on investment is your cheap term insurance, and you don't ever bother to pay for whole life. But the problem is most people don't die during that time. And so it ends up being an expense. There is zero return on it. That's why it's cheap, because insurance companies generally don't have to pay out during the length of those terms. In this situation, we start off, if something tragic happens, obviously your beneficiaries are going to be glad you got that life insurance, as opposed to, they get 1.6 million as opposed to the 400,000 that you could have kept in your checking or savings account as an alternative, right? So really good returns in the early years. They even out in the long term, but the return on the death benefit will always be slightly higher up until, let's see where they combine right here. So our cash value is practically equal to our death benefit, getting close to age 100. Okay. And at some point it is exactly equal. So right here, the next year, age 99, they're exactly the same. So we're going to see the same rate of return at that point. That's how this stuff works. So remember these numbers. We're going to compare the next design. So the next design is we're going to add in that supplemental term rider and take a look at it. So what is the effect if you want access to more cash value? Remember, we're at 82% cash value with this traditional 90-10 design. Oh, next page up. We're at 66,182. Does the class rating affect the IRR, Gyaba asks? Yes, absolutely. Absolutely. So your class rating, otherwise known as your health rating, is going to directly affect the underlying cost of insurance. The higher that cost of insurance, the lower your internal rate of return is going to be because your costs are higher. All right, so I'm going to make this change to the other rider. I'm not changing anything else. Let's make sure that it still works without a mech. It does. Does not let us put 7 years of payments in, though. We're running it a little too efficient. Okay, I'm going to do this two ways. I'm going to save it as is. So everything is exactly the same except for that short-term rider, the short-term PUA rider. Let me save this one. We're going to look at that, and then I'm going to add just a little more death benefit so we can put in the same amount of money, because what we really want to compare is what happens when I put the exact same dollars in and we only make that one change. So the death benefit's going to be slightly different, but there's no way we can get around that with this particular setup. All right, I'm going to need to switch this. What's the best way for me to share this? Let me go back here. We're at 175%. Let's do this one the same size. We are looking at page 17 of the PDF. Okay. Good question, Gil. I will get to that in just a moment. Let me adjust what tab we're sharing here. Oops. Let's go to this one. So here is the different one. Let's just get to, here we go. Oh, it probably says that on this one. I wanted to be able to show you. Now we're using the PUA STP rider. Okay, so our cost, $580 for the 1 year term under that one. On the other one, we were at $585. So the term insurance, slightly less expensive, $5. And look at our cash value. We're at 69. So we got an extra 2,000, 3,000. We were at 66,182. We're now at 69,849. So we got a little over 3,000, 3,700 extra cash value. From a percentage standpoint, 69,849, 69,849 divided by 80,000, 87% cash value. So instead of 82, we got 87. That makes sense, doesn't it? Because What was the cost difference on those PUA riders or the load fees? It was 10% on the other one, 5% on this one. So we got access to 5% more cash value because of this. So 5% more cash value out of the gate. How does that affect us? Well, we can't do the same funding because we're short right here in year 7. You can see our term insurance burns out a little too quickly. But where were we at in year 6? In year 6, we're at 509, 160. In the other design, at year 6, we're at 495. So about 14,000 extra dollars at year 6. Let's go. I don't know if I can just switch this over. I gotta figure out how I can do this. I don't want to remove it. And I don't want to exit the screen share. Oh, Corey, you've been around since my trading videos. Nice, nice. Yeah, I had to step back from that. I got way too busy. Raris, nice. I was making a living trading with Tesla. Well, I wasn't making a living. We were having fun, though. Tesla's a tough beast to tame. I'll tell you what. Appreciate the comment. Appreciate the comment. But yeah, it's, you know, I still trade every day almost. Maybe a couple times a week. I've really scaled back, but mostly because I've got some bad habits when it comes to trading, and I haven't been able to break them. So I've stepped back because I'm intent on breaking those bad habits. And if I continue to just keep doing what I'm doing, I won't break those bad habits. I can make 90% of my trades are really good, but the 10% that aren't, my bad habit is I don't cut the loss, and I end up letting it build up too much. And so I basically give back all the gains that I've got. So it's a really bad habit to get into. All right, we'll just stop the screen share. We'll start it again. So here is back to the other one. I wish there was a way I could just switch that easier. I don't know. I might have to duplicate. Oh, I know how I can do this. Let's do this. Let's duplicate that one. And with this one, we're going to screen share a different tab. I think that'll work. Okay, so do I have the different tab up? That's the question. That looks like I have the same tab. Okay, let's see. Did it? Nope, it doesn't work. All right, still trying to figure out this new software. Didn't work. Let's just get rid of this one. How do I remove it? All right, I'm gonna have to play with this another time. I don't want to waste your guys' time. All right, let's go back to this then. We were looking at down the road a ways. In this scenario, you can't put as much money into the other one by quite a bit, but let's see what the impact is anyways. So we're going to go 30 years into it. So 30 years into it, we are at, let's look at the columns again, cash value column right here, and then our death benefit. So cash value, $2,030,000. This is the full pay of $80,000 for 7 years. The other one, I've got to stop the screen share again and start here. I probably need to use the studio feature to be able to do this. Okay, so oops, I did not do the right one. That's the one we want. Okay, so on this one, 30 years into it, we're at 1.8 million. That's $170,000 difference between those two. At least 170, because the other one was over 2 million. Actually, it might have been right at 200,000. And the difference in funding was $16,000 right here in year 7. So there's clearly something else going on in here with regard to our growth. And that is that rider that gives us access to a little more cash value right out of the gate costs extra. There's extra costs inside this that don't show up here, but it does play out in lower cash value down the road. Now, whole life policies, they're not required to disclose all of the underlying costs like you might see in an IUL, but we can glean what's happening inside here if we know what happens inside of our IULs when we get access to more cash value early on by using special riders. In an IUL, it's called an enhanced liquidity rider. An enhanced liquidity rider does away with surrender charges and gives you access to more of your cash value right out of the gate. But it comes at a cost. You have to pay for that. So when I saw this inside Guardian, I realized what was happening. They didn't tell us that they don't tell us that it costs extra money to do this STP. We just see the result. And we know that that is happening because of that extra cost. So I'm going to make an adjustment again, and we are going to increase the death benefit slightly so we can get the same exact dollars in to both policies. So I need probably 1.63 maybe. Let's try 1.63 and see if that gets us to where we want to be. You're 16 watching those. That's awesome. That's awesome. Did you go by a different name? I don't remember that name. Corey, been around since January 9th, 2021. Nice. Well, I appreciate your guys' support. I did have a lot of fun with that, and we may get back to it at some point. There's a few things that I've been meaning to address, but like one of the things is that I always want to be able to provide you guys, my viewers, with the most value that I can. And because I was struggling with my bad habits in trading, I was watching other people. I was learning as best I could. I was taking classes. I was doing all kinds of stuff to try and figure out how I can break my bad habit and come up with other good trading things, right? Trading methods. And what I realized is there's some really, really good sources of information out there. There's some really good channels. FX, what's their name? FX something. FX Evolution or something like that. Just an amazing YouTube channel that every day that guy puts out really detailed breakdown of what happened in the market. It comes out at the end of the day. Just so much value in that. And like what I felt like was that if I keep doing these live streams and you guys are focused on my channel, maybe you're missing out on those other ones and you're not getting the same value that you could be getting because you're wasting your time on my channel. That was basically how I felt. And so I thought, you know what? I probably need to just stop with that. We didn't have a huge following and it was more of just a community anyways, but I didn't want to inhibit you guys growing as traders because of the problems that I was seeing with my trading, right? I mean, I still had fun and I definitely appreciate the community, but that was why I basically stopped doing that. So I could focus on getting better. And also it was a challenging environment in the stock market. And my hope was that you would find those other channels and learn to become better traders as well. You just changed the profile picture. Oh, okay. That's it. Yeah, you remember for a while. Yeah, I do recognize the name, but I didn't recognize the picture, profile picture there. Well, I hope you're doing well, and I hope you're having success. So I need to add a little more death benefit. Looks like I need to go up to 1.65 million. So we're going to make this change, and then I will do the next PDF and we'll put it up on the screen. That works. Perfect. Okay. So let's save this one. And let's bring that up here. And let's switch it here. So we had to increase the death benefit a little bit. Let's go to the same size. We had to increase the death benefit to 1.65 million. So our underlying cost of that annual renewable term is up to 601. That's an extra 50,000 in death benefit, or 40,000 in death benefit. And it comes at an additional cost of like less than 20 bucks, right? So not too bad. Like I said, that's an inexpensive way for us to increase the death benefit to allow us to do what we need to be able to do. So let's get to page 17. And here we go. So our cash value is still almost the same as it was before, because it should just be $20 different. So we were at 87.3% cash value, 69828 divided by 80,000. Now we're at 87.3% or 0.2% cash value. So just a tiny, tiny impact here, but we're able to get the full 80,000 in for 7 years. So now we're dealing with an apples to apples comparison with the funding of the non-STP rider. Okay. And where do we end up with after 30 years? 1.872. So we were able to get that extra 16,000 in right here, and it led to an extra 40,000 here, but it still falls short by what, 60,000? Let's switch back. This was our original. And we're at, 2,030,000. So 60,000 extra in 30 years by not using that STP rider. Now, we do have access to less cash value right here, right? So we're giving up some access to cash value early on, but we're doing it in order to have more cash value later on. And we're not looking so much later that it's like unrealistic you're going to get to this point. This is age 74, okay? Highly likely that you're still going to be kicking and you'll be able to take advantage of that higher cash value. Let's see what the death benefit is. Death benefit at that same time, 2.812. If we add in that STP rider, our death benefit is 200,000 less. So those are some significant impacts when we blend in that STP rider. That was what I wanted the focus of today to be, so that you guys can just see a time where it might make sense for you to do this is if you are an investor and you literally need access to every penny that you can get, or you might not be able to make a deal, or you just regularly, if your plan was, I'm going to access that because I know I can turn that $1,000 into $10,000 or $15,000. That can make a difference. Okay. But from a percentage standpoint, we're talking a 5% difference in access to cash value here in the first year. It was 14,000 here in year 6, 14,000 in cash value difference. What is that as a percentage? 14,000 divided by what did we put in? We put in 480,000. 14,000 divided by 480. We're talking a difference of less than 3% in cash value here. So unless you need access to every penny you're probably better off going without the STP rider. Now, I have worked with a real estate investor who wanted to pay extra to get access to that liquidity because he did view it as the difference between him being able to take that extra 3,000 or 2,000 or 1,000 and turning that into 20 plus thousand. Now, if you do that, if you're an investor and you do that, even in 1 year, in any of these years, if you used that money that you wouldn't have had access to otherwise, think about the compounding on that extra 20,000. What does that do? Well, it's going to be worthwhile. It'll pay for that STP rider, assuming you can keep it compounding. So there are some instances where it can make sense to do it, but it's very rare. I would say 99.9% of my clients opt not to do that because realistically, they're not looking to borrow every penny out of their policy. And you really shouldn't. It's definitely more risky when you have to borrow every penny, because if something happens and you can't make your next year's payment, you have no cushion built in and you have interest payments that are due on that loan. So you generally don't want to do that. That's why I always like to say we keep our emergency funds in here, capital expense accounts. When you're saving up for taxes, you can keep that in here. Something where you're always going to have a cushion of money in here that will help you get through some tough times. So this is a great place to have that happen. I did a great decision, but the trading live streams you thought were amazing. I am doing well. The insurance business for me has really taken off thanks to all of you viewers on my YouTube channel. I can't say enough how thankful I am for the support and the amount of people that reach out to me to get these really well-designed policies. And I hear over and over that, like, basically what was attracted them to me was my honesty, and that I'm clearly transparent and I'm not just a salesperson. Because, like, when you see this stuff, obviously I'm not making sales pitches in any of this stuff. I'm trying to educate you guys, because my feeling is if you know how these things work, you can see if it'll fit into your financial plan. Now, I can also help you identify if something like this might help your financial plan, might supplement any other investing efforts or complement them. But it's not about sales. I'm not out here, I don't know, just trying to come hell or high water, sell an insurance product to anybody and everybody that I can. That's not our goal. So I do appreciate your guys' support. I think we basically covered the STP rider here. Do you guys have any questions? Anything I might have missed that is that you can recognize? Any questions I left unanswered there? I think what I would like to get into in the next few weeks, if we don't have a policy to review, is we'll go into the 50X, where we can put in 50 times that base premium in the first year. So that'll be coming up. That will be coming up. Yes, Tuesday. Tuesdays are IUL live streams. Thursday's whole life. This last Tuesday, I did a review on a national life policy that was what looked to me like a premium finance case. The person who sent that to me got a chance to watch that video. He said it was amazing, and he signed up for a meeting with me because he still had some more questions. So I'm going to be turning that video, the live stream that I did, into its own video. And in that video, I'm going to have the update after I talk to that person. So I'll be able to add a little more context around that. So it'll be interesting to see if some of the guesses that I assumed just from looking at his policy, if some of those guesses were right. So that'll be cool. Exciting times coming up. I appreciate you guys joining me today. We're going to call it a day. Let me stop my screen share here. We'll go back to here. And there we go. So I hope you found value in today's video. Be sure to hit that like button. Subscribe if you haven't subscribed. Turn on the notifications if you want to know when we're going live. If you have any policies that you want me to review or illustrations from other agents, if you would just like to see a particular illustration designed, let me know. Send me an email, james@OregonCashflowPro.com. Want to meet with me? You got to sign up through my Calendly link. That's the only way that I meet with people. I don't take phone calls generally. In my Calendly, there's a 10-minute phone call option. I always get on there via Zoom, but you can call in if you want to call in. There's a lot of value in being able to access Zoom because I can share my screen. And like for a lot of times people have questions, it's a lot easier for me to show you the answer as opposed to tell you and hope that you remember. And when we meet via Zoom now, it automatically gets a link to you sent afterward to the recording. So you can rewatch it. You don't have to try and remember what we talked about. It's an awesome tool that has only just recently become available to me. And it's gotten incredible feedback from my clients. So, and not even just my clients, anybody who's met with me, because people meet with me and aren't my clients. So just know that's available. And I look forward to hearing from you guys in the near future. And in the meantime, hey, have a great day out there. Hopefully we start to see some better weather coming soon. I know here in Oregon, the rain has just been persistent over and over. Can't wait for the sunshine. Take care, everybody. We'll see you next time.